Management joining us now on what this might mean for your wallet. Chase, good morning. How are you?
Good morning. Doing well. Thanks for having me.
Awesome. Okay, let's talk about, you have 5 areas that you expect to change under this administration. The first up, you expect more government spending, right? But more than just a stimulus deal. Talk about that.
Yeah, so obviously stimulus is the big one. We're looking at about a $1.9 trillion stimulus package, and Janet Yellen, actually the new Treasury Secretary, or the expected Treasury Secretary, I guess I should say, she came out and said we need to be aggressive with this spending here. So not surprised on that front. The other thing, though, you're looking at the Biden administration. They've talked a lot about an infrastructure deal. Green new energy, spending money there. They've also talked about perhaps free college for people that make less than $125,000 as a household. They've also talked about, Medicare for all. So not likely that all of these things will get through Congress, but there's still going to be a hefty bill, I'm going to say, at the end of the day for a lot of these different packages, which could cost the American taxpayers down the road.
Right. And so next, you believe there will be higher inflation. Explain what that could mean, I guess, for the average person here.
Yeah, so if you look at higher inflation, what this is rising costs of goods and services. The reason I'm anticipating higher inflation, it stems from that higher government spending. They're getting more money out to people. The other thing I'm looking at here, it's called the money supply, or M2. And what this incorporates is your checking accounts, your saving accounts, your money market funds, that liquid type money. Last year was about $15.4 trillion circulating in M2. Right now, we have over $19 trillion circulating in M2, just a huge, huge increase. And the way you get inflation is you have too much money chasing too few goods. So again, a lot of money supply. We know some of the manufacturing has been constrained as well. We know, of course, services have been constrained. So I think when we turn back on that spigot, there's going to be a lot of money that wants to be deployed, and that's going to cause some rising prices, right, which of course is inflation.
All right, let's talk about interest rates. How will this, as they begin to rise, how is this tied, though, to inflation?
Yeah, so the way a lot of times interest rates work is that they're correlated with inflation. As inflation goes up, interest rates are a tool to slow that inflation. There's what we call healthy inflation that's 2, maybe 3%. But if you start to get runaway inflation where it gets 4, 5, 6% inflation, that's a big, big problem for the economy. So using interest rates as a tool to make sure we don't get to that type of inflation is what I believe we will see over the next couple of years. And we're coming for a very, very low base on the interest rates. So wouldn't be surprised to see those tick up to maybe 2, 3% over the next few years, which is going to hurt a lot of bonds, investments, your fixed income, real estate perhaps as well. So you got to be cautious where you're looking at during rising interest rates.
Okay. Next, value stocks outperforming growth stocks. What's the difference here?
Yeah, so if you look here, growth stocks, these are kind of your technology companies. You buy them for growth at any cost. You got a company like Tesla trading at 1,800 times earnings. They're growing very, very fastly, but it's very, very expensive. That normally doesn't bode well during rising interest rates, and your value companies, which are generally your financials, they make up a large portion of that group. They do well because they make more as interest rates increase. So I'm looking for more of a shift away from growth and towards value over the next few years.
Okay, and last but not least, Chase, an increase in gas prices. Over the last, I'd say, month, we've already seen a little bit of an uptick. Explain your reasoning here.
Yeah, so I'm looking, as I kind of talked about at the beginning here, is, the Biden administration, they're very focused on green energy. And what this means is that they're looking at putting a lot more regulations on, shale, the fracking, different types of crude oil type investments. So this is going to hurt the supply of oil, which of course relates to gasoline. And I think with those new regulations, you could see gasoline approach $4-5 over the next 1 to 2 years from about the San Diego average of $3.30 today. So not surprised to see that. The problem is you can't turn green energy on in a matter of 6 months. It's going to take some time to switch over to electric vehicles and things of that nature. So I think we're going to see an initial shock when the supply might have some problems over the next couple of years.
Yeah, definitely a lot happening. All right, Chase Wilsey of Wilsey Asset Management. We appreciate you joining us this morning. Thank you.
Thank you so much for having me.
A batch of Moderna's vaccine is on hold after allergic reactions at the Petco Park super site. Fox 5's Jamie Chambers spoke with a local doctor.